Kia ora koutou. Welcome everyone. Ko Jackson toku ingoa. My name is Jackson and I am the director of the Aotearoa New Zealand Stewardship Code. Thank you very much for joining this Stewardship Masterclass today, where we're very lucky to be joined by an international panel of stewardship experts to discuss Stewardship Beyond Equities, or how do investors best influence risks across asset classes beyond equities, such as fixed income and private debt. Before we get into things today, I want to remind everyone that this is going to be an interactive conversation, so we need to be mindful of relevant competition laws. In New Zealand, it's important that no agreements are made on this call. We won't be discussing confidential information, and we have a really clear agenda for this discussion, and we'll be sticking to that. Now, in addition to today's panelists, we're also joined live by many of the signatories to the Aotearoa New Zealand Stewardship Code. The code is a framework to help guide investors on how to best use their influence to support the companies they invest in to navigate critical risks in order to maximize long-term value. If you're interested in becoming a signatory and being part of conversations like this, please visit our website at stewardshipcode.nz to find out more. We're also recording the first half of this masterclass and we'll be sharing this publicly, and we hope you find this valuable if you're watching this online. The second half of this conversation will be a private Chatham House Q&A session between the signatories and the panelists. Right, now for the content. New Zealand has seen a rapid uptake in stewardship practices in recent years, with engagement now being one of the leading responsible investment strategies. The code requires this as part of Principle 4, or Be Engaged, and we regularly see reporting on how investors engage, particularly across their equity investments. The code also specifically encourages signatories to engage across different asset classes and jurisdictions, and we're seeing growing examples of this internationally. So today is a chance to hear from those practitioners engaging with other asset classes to better understand how that can be incorporated here in New Zealand to further improve our risk management processes. To kick us off, I'm going to introduce our first speaker, Laith Cahill, Head of Stewardship Research at IIGCC, joining us from London today to share more about their net zero bondholder stewardship. IIGCC have released a really helpful report on this, and Laith is going to share some of the key aspects from this report in his own aspects. So please welcome Laith.
Morning, everyone, and thank you, Jackson. It's really exciting to be here and a really important subject. My name is Laith Cahill. I'm Head of Stewardship Research at IIGCC, and I've been leading our Bondholder Stewardship Working Group since 2022. So if we turn to the next slide, I'll very quickly talk through who IIGCC are. We bring the investment community together to support progress towards a net zero and climate resilient future. And we really focus on real economy decarbonisation. And that's important when we talk later about engagement. So we have around 400 members across 27 different countries with around $65 trillion under management. And we've long focused on net zero, but our work is now developing into adaptation and resilience, emerging markets and developing economies, and nature. So if we move to the next slide, the landmark IIGCC publication is the Net Zero Investment Framework, and hopefully you'll all be familiar with this. If you're not, it is the most commonly used framework for net zero targets, and we published a revised version in 2024. Now, there's a lot of recommendations in here, but there's two key targets I wanted to emphasize: the asset alignment target and the engagement threshold target. And taken together, these are about how companies are either aligned or aligning with net zero or are under engagement. And importantly for this conversation, it applies equally to both corporate fixed income and to equities. So if we move to the next slide, we've been doing a lot of work in the stewardship research team to think about what this engagement might look like. In 2022, we published our Net Zero Stewardship Toolkit, setting out 5 steps for effective stewardship. But as with most sort of guidance in this area, most practice in this area, it focused on equities. And so in 2022, we launched the Bondholder Stewardship Working Group, and we've seen a really exciting growth from around 9 members to 30 plus investors in that working group. And we've identified a number of challenges, but actually we've identified even more opportunities. I was really excited last year when we had a survey of the working group, and we saw a significant shift in the number of investors who felt that bondholder stewardship could be as impactful or maybe even more impactful than equity stewardship. And that's for any number of reasons. Broader engagement scope. We can include private firms, sovereigns, and state-owned entities in engagements. There's closer links to the costs of capital, with issuers returning constantly to market. And so in 2023, we published our bondholder stewardship guidance, and we follow that up over the last 2 years with supplementary guidance on labeled debt, the opportunity to use different climate-aligned instruments such as use of proceeds and sustainability-linked bonds. And then, rather serendipitously, just this month, we've published summary guidance so that you can have a more digestible 10 pages to go through all of this. Now, if we move to the next slide, I think our main message coming out of most of this is not to be afraid of bondholder stewardship, that it looks very much the same in many aspects as the equity stewardship that many investors have been doing for a long period of time. And so those 5 key steps on the left still apply. We still expect investors to undertake portfolio analysis and develop a stewardship prioritization framework. It's still incredibly important to set net zero alignment criteria and time-bound engagement objectives, a clear engagement strategy, and then a baseline engagement approach. But where we might want to think about creating additionality in bondholder stewardship is how we're thinking about perhaps debt-relevant metrics for that prioritization. So we might think about a company's refinancing needs, and I can talk maybe later about AFII's bond horizon, which looks at when issuers might be coming to market. You might also want to engage more on different types of sustainable financing, again thinking about specific labeled issuances and the related targets. And so out of this guidance, we had really 3 key lessons. The first is the opportunities that are provided to engage both across and beyond the financing lifecycle, taking an issuer-centric approach to engagement. The importance of integrating stewardship into the investment decision-making process. And finally, and it's not covered here, is systems stewardship. I think it's really important in bondholder stewardship to engage across the full range of actors who are responsible for bringing debt to market. So not just engaging with issuers, but thinking about bank DCMs, credit rating agencies, SPOs, and even regulators is a really important part of this activity, and again, creates additionality in those engagements. So I'll pause there and come back for comments and questions in a few minutes. But thank you, Jackson.
Thank you very much, Laith, for that great introduction. It's a really helpful summary, particularly like the point emphasizing the similarities between equity and these bondholder engagements, which we'll dive into more shortly. But before we do, I'm now going to introduce Alison Chan, Investment Director, Sustainable Finance at Metrics Credit Partners, a leading private debt manager in Australia and founding signatory of the New Zealand Stewardship Code. Alison's going to summarize some of the key differences they found when engaging in private markets versus public markets and some other comments. So welcome, Alison.
Thanks very much, Jackson, and good afternoon to everybody joining today. As Jackson mentioned, I lead the sustainable finance team at Metrics Credit Partners, and we manage over $30 billion of private market assets, predominantly in credit, but with some equity. And we are fortunate to have a sustainable finance team of 4, which affords us the capacity to engage in a wide range of stewardship activity. Thanks, Jackson. So as Jackson mentioned, I've been invited to spend a few minutes looking at our approach to stewardship in private markets. And we approach stewardship at 3 levels: company level, industry level, and policy level. And what constitutes stewardship at each level differs, and we'll look at each separately in a moment. And even though different teams within the firm might be involved in each level, we coordinate through our sustainable finance team to make sure that our advocacy is consistent and coordinated. The main themes for us are climate, human rights, modern slavery, and diversity. And this is, of course, driven by the urgency of the climate crisis, as well as mandatory reporting obligations and the interests of our investors. Our science-based targets also make it critical for us to engage with investees on climate. So if I look at company level engagement, it's important to bear in mind that in private markets, most entities are modest in size. Each individual entity most likely has a negligible impact on the biggest global challenges, climate, nature, human rights. But it's still important to engage with them because collectively they're a big part of the economy and we can't afford to ignore them if we want to make progress on some of those big challenges. Perhaps more importantly, the individual financial performance of those investees can still be affected positively or negatively by sustainability issues. So we apply a double materiality lens to deciding where we should focus our stewardship efforts. We think about the investees' impact on people and the environment, but we also think about the risk to their business from impacts on people and the environment. I think our investees' modest size is probably the biggest stewardship challenge in private markets. They just don't have the same drivers to meet the expectations of public market stakeholders, such as, for example, publishing reporting. They might even be below the thresholds for mandatory reporting on climate, gender, or modern slavery. So we're necessarily asking them to provide data they might not otherwise capture or do things that they otherwise would not need to do. They are unlikely to have dedicated sustainability resources and can generally have limited capability and capacity to undertake major sustainability initiatives. We need to be pragmatic as a result and do as much as we can to make it easy for them to pivot towards the outcomes we'd like to see. Bearing in mind always that sustainability is generally not their day job. So one example of something that we're doing at the moment is an emissions measurement pilot with a group of our investees. So we have paid for them to access the Toy2 platform, and we're holding workshops for them and offering one-to-one practical assistance to help them gather the data they would need to put into that platform. We expect that by the end of the pilot, every one of those participants, none of which have ever measured their emissions before, will have a full Scope 1 and 2 greenhouse gas inventory, a Scope 3 if they would like it, and be able to report their measured emissions to us. So that's a rare example of measurable outcomes from a stewardship initiative. The pilot will have an immediate effect on the accuracy of our own financed emissions measurement. And we expect it'll indirectly lead to real-world emissions reductions because these investees will be able to see for the first time where their emissions lie. And of course, we're hoping that in future they'll be addicted and they'll move on to set their own targets, which will help us meet our targets. So the flip side of the coin, our investees' modest size is also a stewardship advantage. Unlike public markets, we have direct relationships with our investees, and those investees have fewer investors. So collaborative engagement doesn't tend to be relevant, and we're not limited to voting and other shareholder actions. We've got direct access that investors in public markets often don't have. Our relationship teams can be in day-to-day contact with management of our investees, and that gives us the opportunity to raise issues informally and in real time. When it comes to escalation, many of our investees are supported by private equity funds. Where we need to, we can engage the equity sponsors. They'll usually take our call because of the strength of our relationship across the various entities in their portfolio. If all else fails and we'd like to exit, of course, the options differ from public markets. There's no bid waiting for us to hit. We would prefer to stay in and work with management to remain part of the conversation if we can. But if we don't think that's going to be productive, our options are to sell or to refuse to refinance at maturity. So very often the time frame is fixed. If we could now think about industry level stewardship, we make the most of our membership organisations here. I guess you're all aware of the work that the Stewardship Code does to raise the standard of stewardship in New Zealand. So I haven't included that on this slide, a bit short of space. These are some of the other industry collaborations we participate in. While most of the examples relate to initiatives to raise the standard of responsible investment, there is also some overlap with policy level stewardship, which we'll talk about in a second. outside those industry bodies, we also collaborate with independent experts and academics. Last year, we developed 2 short courses for finance professionals with the University of Technology, Sydney. And that initiative was in direct response to the Australian government's acknowledgement of the need to upskill finance professionals generally in sustainable finance. And so we made those courses, piloted them in-house and made them available to the market. Finally, policy level stewardship in private markets. So given the challenges that we've talked about associated with our investees' modest size, we put a lot of effort into policy level stewardship. That's how we think that we can help generate across the board outcomes. Because when an investee has limited resources, we need to be mindful that we might be asking them to divert their attention from other important business initiatives. And that could be detrimental to the performance of their business and consequently prejudice them in comparison with their peers. It would also clearly put us as investors at a disadvantage in a competitive market if we were looking to impose expectations beyond the market. No matter how important an outcome might be to us, it's not going to be achieved if we're not in the deal. So it's important for us to raise the bar for everybody so that neither our clients or us are at a disadvantage by encouraging sustainability. So our policy level stewardship aims to create a more enabling environment to help drive our sustainability objectives. We also think, as I said before, that the work we do at policy level is the best way for us to address systemic sustainability risks and achieve system-wide outcomes. So we engage with governments, policymakers, standard setters, and the techniques we include are listed there, from signalling our commitment by signing up to NZAM or becoming a TNFD early adopter, by signing on to letters and joint statements, by contributing to standard setting. One of our team members sits on the PCAF Global Core team, developing standards for measuring financed emissions. And through our memberships, we comment on government consultations and reports. We participate in collaborative initiatives that target specific issues. Recent focus areas include embodied carbon, affordable housing, and Australia's NDC. And finally, we take opportunities to join delegations to meet face-to-face with policymakers. So in closing, I'd perhaps controversially say that the approach we take to stewardship in private markets is more hands-on and relationship-driven than in public markets, in that it's multi-pronged and involves a lot of interaction with internal and external parties. So thanks, Jackson. I'll look forward to any questions in the second half of the session.
Thank you, Alison. That's a really interesting presentation, and I think there's a lot of analogies actually between how you've described the modest organisations that you invest in with actually the New Zealand market and the generally smaller businesses in the New Zealand market. And so I think a lot of the points you've made can extend to stewardship quite broadly in New Zealand, which is interesting. I also like what you said about those companies becoming addicted to setting targets. So I look forward to hearing how that goes. But without further ado, I'll now introduce our final speaker for this part of the webinar, which is Ghislaine Nadaud, the Director of Sustainable Investing at Robeco. Ghislaine is going to discuss some of their engagements across fixed income in particular, which is a real substantial asset class in New Zealand. So thank you, Ghislaine.
Thank you, Jackson, and thank you for having me on this panel. Great opportunity for us also to share our approach. I think some comments already made are very recognizable for us. For example, the difference between engagement on equities and fixed income is not that big. So indeed, it's just, I think, different stakeholders involved. And well, let me start with the first slide. And I think it's also an evolving space, so I'm really great that we have a webinar on this. Introducing the various flavors of investor stewardship that we have: voting, we have equities engagement, public policy engagement. I think Alison just explained how you can approach that. We have a similar approach, so we also engage with governments, policymakers, and regulators, especially I think relevant in the region here. I'm based in Singapore, in emerging markets where there are a lot of developments on sustainable guidelines and regulations where we contribute via consultations, etc. And then we have bondholder engagements where we engage with corporates and sovereign debt issuers to promote sustainable practices. And I will deep dive into that in the following slides. So bondholder engagement, it's really a way how we can strengthen our stewardship approach. We can do that via corporate bondholder engagement. So why are we doing that? Well, implementing transition plans will require massive investments from corporates to align themselves with a net zero emissions pathway. And there's an incentive for corporates, especially from high-emitting sectors, to raise capital for the transition with green, social and sustainability bonds. So a coordinated engagement across equity and debt can increase our influence and also our consistency in messaging. So what can we do? Well, we can push for stronger rights and sustainability-related restrictions in bond contracts. We can also, there are multiple contact points to engage with issuers throughout the debt cycle. It's also pre-issuance of the bonds, but also post the issuance. So there are multiple contact points where we can engage. And then I think it's important that there's a complementary angle, so integrating credit and equity perspectives enhance our investor voice and also our credibility, and it helps with our issue analysis. How do we do our corporate bondholder engagement? Well, bilateral. I think it is sometimes indeed more difficult to get access, but there are various ways how we can get access to companies, to issuers. So we do bilateral engagement with corporates. Collaborative, very important as well on corporate bondholder engagement, so via various initiatives, for example, also Climate Action 100, and via syndicating banks. So we use the banks in our engagement to provide feedback, for example, on what we expect issuers to see, for example, in their green bond frameworks, etc. If we go to the next slide. So this is an example of our approach for our Transition Asian Bond strategy. So our engagement, who is involved internally, and what type of moments do we engage, and also who is involved externally on this Transition Asian Bond strategy. So of course, a stewardship team, but our SI research team is also involved. They do the company analysis and also provide thematic research. Of course, our credit team and our global macro team, and the credit team also involves our bond specialists. And sales is also involved in this as well. So we engage with existing issuers to improve the alignment with green bond and GSS bond standards, and also with our framework. But there's also an opportunity to engage to aim to bring new GSS bonds to the market. So two angles, two goals in our engagement, you could say. Our engagement is also informed by external experts. And again, this is related to transition. So it's Just Transition Finance Lab that we consult, GFANZ, Singapore Sustainable Finance Association. So I think it's important indeed to have that collaboration with them as well. So for example, here we engage with a utility company from Malaysia with our bonds team to provide feedback on their green bond framework. That is an example of corporate bondholder engagement. If we go to the next slide. On top of corporate bondholder engagement, we are also involved in sovereign debt engagement. We started that engagement in 2022, where we focus on supporting countries in helping them to achieve the Sustainable Development Goals. We engage with the governments of Brazil and Indonesia on SDG 15, focusing on the issue of deforestation. And with Australia, we engage on on its climate strategy and climate action, SDG 13. And the goal is really to highlight public policy gaps, to test environmental safeguards, and to coordinate policy dialogue to mitigate various risks, climate risks, but also other risks. Indeed, on sovereign debt engagement, it is key to have collaborative engagement. So the engagement with Australia, we do that with the PRI, via the PRI. And with Brazil and Indonesia, it's really focused on the issue of deforestation. So there we engage with the investor policy dialogue on deforestation. I think the engagement, the sovereign engagement with Australia was first one coordinated by the PRI, and it has been quite successful. So now they're expanding this year to other countries. Canada is one of them, and Japan. And we will also be active in the engagement with Canada. So the dialogue focuses really on government authorities, so Treasury Department, Ministry of Energy, etc., but also other relevant stakeholders. And I think that was also mentioned by Laith. So it's really the broader spectrum. So it's local academics, local NGOs, very important again to inform your engagement, but also have, for example, political parties and also corporates that are based in those countries. Assessing our efforts, we have developed an internal reporting framework. We are also continuously trying to improve that, to also be more transparent about that, and also to see, well, the progress in our dialogues. And I think we will discuss the effectiveness later in the panel as well. So maybe to the next slide. What are our lessons learned, outcomes, and next steps from our engagement efforts with Australia, Brazil, and Indonesia? Sorry, for Brazil and Indonesia, we started actually a little bit earlier, 2020. So the case selection, the countries that we want to engage with, is based on our ESG country framework. The investment teams, of course, and also our global macro team, and that works really well. To have that collaboration internally on the case selection. As I mentioned, collaborative engagement is key. And no one size fits all approach. Had a local context, etc. is very relevant, of course. It's a bottom-up research approach, and we have developed a sovereign engagement working group internally, where we outline our strategy for engagement. So the outcomes of engagement to date, we established robust access to both national and state government entities in Australia. The lessons learned from our dialogue with government of Brazil and Indonesia is that it's really key, especially in emerging markets, I think, that how you have regular in-country visits to build up the access and relationships. In August, with regard to the Australia engagement, last year, with the engagement with the Treasurer and Minister of Climate Change, we asked for a more ambitious NDC, and it will be very interesting to see what will come up in the coming months. And the outlook is that, well, as I mentioned, we have expanded our sovereign engagement with Canada, and the PRI is again coordinating this. We also have formulated our approach to expanding our sovereign engagement as part of our net zero roadmap. So we are in the process of updating our net zero roadmap. And on top of corporate engagement, sovereign engagement is a really important element on climate, but also on nature. In our sovereign engagement activities, we have now also defined an approach of in-depth engagement activities. So that is, for example, the engagement with Australia, Brazil, IPDD, but also, being part of, well, less in-depth, but more consistent. And that is, for example, being part of work streams on development of regulations, and one-off engagement that is just, having one-off engagement or meetings with governments, for example, on their climate approach. This was my last slide. Thank you. Looking forward to the discussion.
Thank you very much, Ghislaine. There's a lot of very interesting and relevant insights in there too. I think one of the topical ones is the sovereign debt engagement, which I know there's some growing conversations in New Zealand around how something like that could look in New Zealand. So it's very timely. Thank you very much to all of the panelists. I'm conscious of time now, and I do want to ask one quick question before we finish this publicly recorded section of the webinar. And Laith, I might pass this question to you. One of the things I was quite interested in when we were preparing for this webinar was your commentary around the different cadence of debt-focused engagements versus equity-focused engagements. And so I wondered if you could just describe that for those watching. How does the cadence differ for bondholder stewardship versus a traditional equity engagement?
Yeah, thanks, Jackson. I think it's a really interesting question, and again, touches on how bondholder stewardship might be the same, but also might be slightly different. So we're all familiar with the annual process around the AGM, the hoopla around the AGM. Obviously, for the corporate debt issuer, it's not based around that annual AGM, and instead we have the multiple contact points that Ghislaine mentioned. And I think this is really important. And one of the reasons is that IIGCC recommends that investors take a sort of issuer-centric approach to engagement. So not just looking at the specific issuance and the time horizon there, but thinking about what happens beyond. And why that might be important is that a company might not be repaying its debt from its existing liquidity. So it's not as easy as saying, I have an 8-year bond, the risks don't materialize until 10 years, so I don't need to engage on climate. Actually, those risks will materialize as the company relies on accessing new debt capital to refinance that maturing debt. And so what we want to think about is how do you engage across that financing life cycle? But there are some moments where you have higher influence. So what we found is that engagement is likely to be more effective when issuers are looking to raise funds in the capital market. So we're really looking at that pre-issuance and refinancing phase for talking both to the issuer but also to the bank syndicates, as Ghislaine mentioned. I mentioned AFII's Bond Horizon, and this is a really helpful tool that investors can check out. It helps identify companies that may soon come to market and supports engagement in that way. The other area where you have perhaps a lot of influence, depending on your size perhaps, is at issuance. But whenever we say this, a lot of investors roll our eyes because you have a very limited time window. And I think that is obviously true. And we're not suggesting that investors are engaging in that short buy moment. But what we are looking at more, and what we've been discussing with investors, is how we can communicate investment decisions to issuers and bank syndicates, why an investor was overweight or underweight on a specific issuance. And so what we think about is how engagement doesn't have to end with divestment or doesn't have to end with being underweight. I think in our summary guidance, we've provided template examples for how investors might communicate those investment decisions to the syndicates, providing an on-ramp to companies returning to the investable universe, and then you start the process all over again. So I think there are those multiple touch points. I think really engaging pre-issuance can be incredibly helpful. We've seen how those expectations are brought forward in green bonds and sustainability linked bonds. And also maybe just finally, one of the areas where again you have these slight differences is with the provision of labeled bonds, you often have more opportunity to engage post-issuance. So there's that ongoing dialogue around impact reporting, ongoing dialogue around progress towards targets. A really interesting example was with Enel and our sustainability-linked bonds, where the company wasn't going to meet targets, but actually it gave the investors a very clear rationale for why those targets weren't being met and why the company was still committed to its net zero targets. And that allowed for a more sort of interesting discussion going forward. And so engagement isn't necessarily just about finding out whether or not the targets will fail, but why and how. And so that post-issuance engagement can be more effective as well. So lots of touch points, especially pre-issuance, but a lot of opportunities for more as well.
Fantastic. Thank you very much, Laith. I think that point around the particularly effective times to have those conversations across these asset classes is really insightful. All right, well, that brings us to the end of the public portion of this webinar. So I just want to thank those who are watching online. And if you want to discuss any of this further or learn more about the Aotearoa New Zealand Stewardship Code, please feel free to visit our website anytime or contact me. So thank you for joining.